Of knowledge, let's get right into it with VIC readings, the format where we look at the best of the best value investment recommendations by the best of the best value investors out there. Today we have Berkeley, tickers Berkeley WR Corp, tickers WRB. Price at the point of filing is $66.21. Market cap is in 1,018,000. 12 years ago, let me first say that's not recommendation, not advice. Please do your own diligence before investing into anything. Let's get right into it. 12 years ago, Vinland wrote a well-deserved VIC winner on WRB. The valuation was compelling and his analysis excellent. The stock has compounded with dividends reinvested at over 15% per year since. Nice. That's our benchmark. They hit it. I would strongly encourage anyone with an interest in the company to read the report and the responses to the subsequent comments and questions. While much has changed in the ensuing years, Winland captures the spirit and culture of the company. Okay, I like that too. A company stayed true to themselves, stayed rather the same. Not just true to themselves, but a not that much change in industry. I assume Berkeley was a great idea then. It is a very good idea today for those of you looking for stocks you can own for a very long time. There are two keys to success in the property/casualty industry: establishing sufficient reserves and a willingness to relinquish business when pricing is unattractive. WRB, which will mark its 50th anniversary as a public company this year, has proven itself on both counts. Not coincidentally, Berkeley at 77 is still deeply engaged, owns 20% of the stock. His percentage ownership has actually risen over the last decade given corporate repurchases, and has created a system where the top 70 or so executives receive large stock grants tied to corporate returns, which must be kept until after they retire. The owner operator ethos and focus on risk adjusted returns is pervasive. Pushback. All well and good, but the stock has been great and it's over 2x book value. Everyone knows the story, and yes, we're in a hard insurance market, but the rate of change is slowing, and after hard comes soft. So, isn't it too late or too early? Responses. Number one, the market is less homogeneous than in the past, so it is not as meaningful to generalize about the P and C cycle. One very important market segment, workers' comp, is extremely competitive with eroding pricing. CEO Rob Berkeley has been wrongly predicting an upturn in the market for over 2 years, but responding to the soft market, the company has lessened its exposure here. Most recently, on the Q4 call, he suggested that it would bump along the bottom in 2023 and could show considerable firming in 2024 and beyond. An opportunity lies closer at hand in the property market, both reinsurance and insurance, because of hard reinsurance market. Though historically WRB does not have as much exposure to property as casualty lines, its decentralized structure and willingness should allow it to capitalize upon this opportunity. Finally, Rob suggests that a healthy amount of business is still migrating from standard lines to the excess and surplus lines that have traditionally been WRB's sweet spot. For these reasons, I conclude that business conditions will remain stronger for longer than many expect, especially for a company that has demonstrated an ability to be opportunistic. Second, investment income should surge higher. At 12/31st, WRB had $24.5 billion in invested assets, $88 per share. The duration of the fixed income book is 2.4 years, kept deliberately short over the last several years. Hence, repricing to new money rates, which are now over 5%, will happen in short order. As Bill Berkeley noted in September at the KBW conference, many underestimate the earnings power of a business like the one we work for when it comes to where interest rates can take investment income. I do not have access to sell side models, but I suspect he is right. 3. Since 2000, the stock has declined in only 4 years: 2007, 2008, and 2009, and 2020. Incredibly, there have only been 2 times in the same period, including intra-year moves, where it has had 20% or more peak through declines. My point is that one doesn't need to wait to try to time the beginning of the next hard market to buy WRB. 4. Though not perfect in timing, the company has been astute in buying back stock over the years. The most notable example was in the COVID market of 2020. WRB bought back $346 million of stock at an average price of $36, a meaningful amount and, in hindsight, a very well timed purchase. Beginning in 2011, there have been 10 quarters in which repurchases exceeded 50 million. In each case, the stock appreciated 1 year out, and looking 3 years out, of course, with the first 2 quarters of 2020, we do not yet know exactly, but it looks as if it will be in the case. Produced a total return of at least 40%. So I think it is noteworthy that in the recent fourth quarter, the company bought back $87 million at an average price of $69. We all have become cynical about share repurchases and can go into chapter and verse about egregiously mistimed buybacks. But always remember that Bill Berkeleey began his career as an investor and approaches the world with that lens. Earnings power / valuation. EPS should top at $5 in 2023 and be in the $6 neighborhood in 2024. Looking out 2 years, most, if not all, of their unrealized investment losses in the bond portfolio should reverse. Accordingly, tangible book value $24.58 at 12/31st, 2022 should rise to the high 30s. High interest rates are leading management to be much more confident about reaching and exceeding the long-term goal of a 15% ROE. On this basis, I think a 18 to 24 month target in the $80 to $85 range is very realistic. I hope and expect to own the stock for much longer. Risks / concerns. This is a black box industry, and reserve adequacy should always be the greatest concern for investors. I take comfort from the large insider ownership, the track record, well laid out in the attached corporate presentation, the emphasis on small individual risks, and the meaningful decline in the paid loss ratio in recent years. Catalyst? I wish I had one. Thank you very much for tuning in. See you next time. Please write down in the comments below what you think of this idea.